Chapter 3: A Century of Stock Market History. If you had invested $10,000 in the S&P 500 in the year 2000, by 2002 you would have had $6,000 left. You lost 40% of your money. But if you did the same thing in 2009, by 2011 you would have nearly doubled your money. This is the chapter where Benjamin Graham destroys your crystal ball. He proves with cold hard data that Wall Street's favorite pastime, forecasting the future, is a scam. Today, we are going to learn why experts are usually wrong, how to spot a bubble before it pops, and how to invest when you have absolutely no idea what will happen tomorrow. Let's dive into the biggest trap in investing. This time is different trap. In every bull market, people start to believe the rules have changed. In 1929, they said it was a new era. In 1999, they said, the internet changes everything. In 2021, they said, crypto changes everything. Sound familiar? Graham calls this dangerous thinking. He noticed a simple but devastating pattern. Step 1, the market goes up for a few years. Step 2, investors assume it will keep going up forever. Step 3, they start buying stocks at any price, completely ignoring what the company is actually worth. And step 4, gravity returns and everything comes crashing down. Graham's warning in Chapter 3 is simple. Do not project the immediate past into the future. Just because stocks went up 20% last year does not mean they will go up 20% this year. In fact, historically, periods of high returns are usually followed by periods of low returns or even losses. This is a concept called reversion to the mean. What goes up, especially too fast, must eventually come back to its average. Think of it like a pendulum. It swings high on one side, but it can't stay there. It always swings back through the middle and often to the other extreme. When everyone is euphoric and thinks they've found the secret to permanent wealth, that's precisely when you should be most careful. Graham's point isn't to be a pessimist. It's to be a realist. The market has a long and brutal history of humbling those who think they can outsmart it. So, if we can't predict the future, are we just flying blind? Not at all. Graham gives us a tool. Think of it as a thermometer. We can't tell what the weather will be next week, but we can definitely tell if it's hot or cold right now. That thermometer for the stock market is valuation. Graham looks at the price-to-earnings ratio, or PE ratio, of the entire market. This simple number tells you how much investors are willing to pay for every dollar of a company's earnings. When the PE is high, say over 25, it means the market is extremely optimistic. People are paying a huge premium. Graham would call this a high-risk environment. It's like buying a summer coat in the middle of a heat wave. You're paying top dollar. Conversely, when the PE ratio is low, let's say under 15, the market is pessimistic. Fear is everywhere. But this is where the intelligent investor sees opportunity. Stocks are on sale. This is a high-opportunity environment. It's like finding a high-quality winter jacket for 70% off in July. You might not need it right now, but, it's a great deal. In modern times, we often use a more advanced version of this called the Shiller PE ratio, or CAPE ratio, which smooths out earnings over 10 years. And when you look at a chart of the CAPE ratio over the last century, a clear pattern emerges. Every time it hits a major peak like in 1929-2000, and 2021, a market downturn tends to follow. The intelligent investor's strategy isn't about predicting the exact day of the crash. It's about recognizing the temperature. You buy when the thermometer is low and you become much more cautious, perhaps selling some of your overpriced holdings when the thermometer is bursting. This brings us to the core of Graham's philosophy for the average person, the two-bucket strategy. Instead of trying to time the market, which we've established as a fool's errand, you divide your money. Graham suggested a simple split, one bucket for stocks and one for bonds. Your default position might be a 50-50th split. Now, here's where the valuation thermometer comes into play. When the market gets hot and expensive, when that PE ratio is soaring, you don't panic sell everything. You simply and calmly rebalance. You sell some of your now overpriced stocks and move that money into the safety of your bond bucket. You might shift your allocation to 25% stocks and 75% bonds. You're taking profits off the table and reducing your risk when everyone else is getting greedy. Then, the opposite happens. The market crashes. Everyone is panicking. Headlines are screaming, sell, sell, and the PE ratio is in the bargain bin. What do? You do the opposite of the crowd. You calmly rebalance back. You sell some of your safe bonds and use that cash to buy stocks at a massive discount. You might shift your allocation to 75% stocks and 25% bonds. This is the ultimate buy low, sell high strategy, but it's systematized. It removes emotion from the equation. You're not guessing. You're reacting to the market's temperature. This discipline is what separates the intelligent investor from the speculator. It forces you to be greedy when others are fearful and fearful when others are greedy. Let's make this real. Imagine it's late 1999. The dot-com bubble is in full swing. Petscom is a household name, and your neighbor is quitting his job to day trade tech stocks. The Shiller PE ratio is at an all-time high, over 44. The thermometer is screaming hot. The intelligent investor, following Graham's advice, would have been trimming their stock positions all the way up, rebalancing into bonds. They might have felt a little foolish for a while as the market kept climbing. But when the bubble burst in 2000 and the Nasdaq fell nearly 80%, who was sleeping soundly? The investor who had locked in profits and was sitting on a pile of safe bonds. Then, fast forward to March 2009, the financial crisis has wiped out the market. The world feels like it's ending. The Shiller PE ratio has plummeted to around 15. The thermometer is ice cold. Everyone is terrified of stocks. But the intelligent investor sees the sale of a lifetime. This is the moment they've been waiting for. They rebalance aggressively, selling their safe bonds and pouring that money into the stock market, buying shares of excellent companies at prices not seen in years. The people who did this saw incredible returns over the next decade. They didn't predict the bottom. They didn't need to. They just followed the thermometer and the discipline of rebalancing. So, what's the key takeaway from Chapter 3? Stop trying to be a fortune teller. Wall Street pays people millions to predict the future, and they are consistently wrong. Instead, become a historian and a realist. Understand that markets move in cycles of greed and fear. Your job isn't to predict these cycles, but to recognize them and react rationally. Use valuation, like the PE ratio, as your thermometer to gauge the market's mood. Is it euphoric and expensive, or is it terrified and cheap? And finally, implement a disciplined strategy, like Graham's 50/50th stock bond split with rebalancing. This automates the process of buying low and selling high and protects you from your worst enemy, your own emotions. Investing isn't about having a crystal ball. It's about having a rock-solid, time-tested process. Turn on the TV and what do you hear? The market is going to the moon. The S&P will hit 6,000 by year-end. Then you change the channel. A massive recession is coming next month. Sell everything. It's enough to give you whiplash. You know who hated all of this noise? Benjamin Graham. He laid it out crystal clear in his book. He said, "We have not known a single person who has consistently made money by following market forecasts." Let that sink in for a moment. This isn't some random guy on the internet. This is the father of value investing, Warren Buffett's mentor, telling us that all those experts shouting on TV, they don't know what's going to happen. Nobody knows anything for sure. Think about what this means for you. If you build your entire financial life on a prediction, you're not investing. If you say, "I'm sure the market is going to crash, so I'm holding all my money in cash," you are speculating. You're essentially gambling on a guess. And if you're wrong, you miss out on potentially life-changing gains. On the flip side, if you go all in because someone promised you the market would double, you're setting yourself up for potential disaster. The intelligent investor operates from a place of humility. They admit they don't have a crystal ball. They don't know the future. And because of this, they build a portfolio that is designed to survive any future. A crash? They're prepared. A surprise rally? They're positioned to benefit. This is about building a robust, resilient financial fortress, not a flimsy tent based on a weather forecast that's probably wrong anyway. So how do we actually do this? If we can't predict the future, how on earth are we supposed to invest our hard-earned money? This is where Graham gives us a brilliant, actionable framework. I call it the history-proof protocol. It's a system that doesn't rely on guessing games. It relies on principles that have been proven to work over decades of market ups and downs. So, I want you to grab your phone or log into your brokerage account right now. We're going to do a quick checkup on your portfolio. This is a practical, hands-on exercise. There are 3 simple things I want you to look for. First, the allocation check. This is the bedrock of your portfolio stability. Graham suggested a simple baseline, a 50-50th split. That's 50% in stocks and 50% in bonds, or even a high-yield savings account. This is your neutral gear. Now, here's the intelligent part. You don't change this allocation based on a news headline or a gut feeling. You change it based on value. How does that work? You look at the overall market's valuation, often using something like the price-to-earnings or PE ratio. When the market gets super expensive, when everyone is euphoric and prices are sky-high, you might lean more defensively. Maybe you shift your portfolio to 25% stocks and 75% bonds. You're reducing your risk when the odds are less in your favor. Conversely, what happens when the market crashes? When there's blood in the streets and everyone is panicking? That's when valuations become cheap. That's your signal to lean in. You might shift to 75% stocks and 25% bonds. Notice the key difference here. You are adjusting based on price and value, not on some wild prediction about where the market is going next week. You're being a business person, buying more when things are on sale and less when they're overpriced. The second part of the protocol is the DCA rule. DCA stands for dollar cost averaging. This is one of the most powerful, and yet simple, concepts in all of investing. It means you invest the same dollar amount on a regular schedule, say, every month, regardless of what the market is doing. Whether the headlines are screaming bull market or bear market, you invest. This simple act of consistency automates Graham's core logic. Think about it. When prices are low because the market has fallen, your fixed dollar amount automatically buys more shares. When prices are high, that same dollar amount buys fewer shares. Without any emotion or guesswork, you naturally end up buying more when things are cheap and less when they're expensive. It's a built-in discipline that forces you to act like an intelligent investor, even when your emotions are telling you to do the exact opposite. And finally, the third check, the 20-year horizon. I want you to stop looking at the 1-year chart of the stock market. Seriously, it's financial junk food. It's full of jagged, scary drops and volatile swings that are designed to make you panic. It tells you nothing about the true nature of long-term investing. Instead, pull up a 20-year chart of the S&P 500, or even longer if you can. What do you see? Yes, the line is still jagged. You'll see the dot-com bust, the 2008 financial crisis, the COVID crash. These are all scary vertical drops. But zoom out and look at the overall journey. What is the undeniable destination? It's up. The overall trend over any meaningful period of time is upward and to the right. History tells us, with 100% certainty, that the market will crash again. It's not a matter of if, but when. But that same history also tells us that it will recover. Every single time it has recovered and gone on to new highs. The only people who truly get hurt in this process, the ones who lock in permanent losses, are the ones who panic and sell at the bottom, or the ones who get greedy and go all in with money they can't afford to lose at the very top. By following this history-proof protocol, maintaining a flexible allocation, automating your buys with DCA, and keeping a long-term perspective, you remove the 2 biggest enemies of your financial success, fear and greed. You build a system that allows you to not just survive the inevitable storms, but to actually profit from them. You can sleep well at night knowing your financial future isn't built on a guess, but on a time-tested, proven strategy. Thanks for watching, and don't forget to subscribe for more insights that can help you build real, lasting wealth.